I want to reveal the concept of beta and Sharpe ratio. So that's so your portfolio return. This is your benchmark return, R of M, expected return. This is the RF is the risk-free return. So essentially, your cash return, and the alpha is what you can generate additionally. So let's even not to worry about this small other terms, or not necessarily small, but for the simplicity, I'll just reveal that. So that's your beta. What is your Sharpe ratio? Okay, and you can So sometimes Sharpe ratio is also called risk-weighted return or risk-adjusted return. Okay, and how many of you have heard Kelly's formula? So Kelly's formula basically gives you that when you have, let's say, in the gambling example, you know your winning probability is P. So this basically tells you how much to size up, how much you want to bet on. So it's very simple formula. So if you have a winning probability of 50-50, how much you bet on? Nothing. So if you have P equal to 100%, you bet 100% of your position. If you have a winning probability of negative 100%, so what does it mean? That means your 100% probability of losing it. What do? You bet the other way around, right? You bet the other side. So when P equal to negative, I'm sorry, actually what I said, when P equal to 0, your losing probability becomes 100%, right? So you bet 100% the other way. Okay. So that I leave to you to think about. That's when you have discrete outcome case. And but when you construct a portfolio, this leads to the next question is, in addition to the efficient frontier discussion, is that really all about asset allocation? Is that how we calculate our weights of each asset or strategy to choose from? The answer is no, right? So let's look at the 60-40 portfolio example. So again, two assets. Stock has, let's say, 60%, 40% bonds. So on this, So typically, your stock volatility is higher than the bonds, and the expected return is also higher. So your 60-40 combination is likely fall on this on the higher return and the higher standard deviation part of the efficient frontier. So the question was, so that's typically people do before 2000. A real asset manager, the easiest way or the passive way is just to allocate 60-40. But after 2000, what happened was, when after the equity market peaked and the bond had a huge rally, right? As first, Greenspan cut interest rate, and before the Y2K, year 2000. You think it's kind of funny. At that time, everybody worried about the year 2000 coming up. All the computers going to stop working because all the software were not prepared for crossing this millennium event. So they had to cut the interest rate for this event. But actually, nothing happened, so everything was okay. But then left the market with plenty of cash, and also after the tech bubble bursted. So that was a good portfolio, but then obviously in 2008, when the equity market crashed, the bond market, the government bond high-grade market had a huge rally. And so that made people question that is this 60-40 allocation of asset simply by the market value, the optimal way of doing it, even though you're falling on the efficient frontier. But how do you compare different points? Is that simple choice of your objectives, your situation, or there's actually other ways to optimize it? So that's where the risk parity concept was really, the concept has been around, but the term was really coined in 2005. So quite recently by a guy named Edward Chen. He basically said, okay, instead of allocating 60-40 based on market value, why shouldn't we consider allocating risk? So instead of targeting return, targeting asset amount, let's think about a case where we can have equal weighting of risk between the two assets. So risk parity really means equal risk weighting rather than equal a market exposure. And then the further step he took was, he said, okay, so this actually, okay, is equal risk. So you have lower return and the lower risk, a lower standard deviation. But sometimes people really want a higher return, right? How do you satisfy both? Higher return and lower risk. Is there a free lunch? So he was thinking, right? So there is, actually. It's not quite free, but it's the closest thing. You probably heard this phrase many times. The closest thing in investment of free lunch is diversification. Okay. And so he's using a leverage here as well. So, but let me talk about a bit more about diversification. Give you a couple of more examples. Okay. That phrase about the free lunch and the diversification was actually from, is that from Markowitz? Or people gave him that term? Okay, but anyway, so let me give you another simple example. Okay, so let's consider two assets, A and B. In year one, A goes up to basically doubles, and year two goes down 50%. So where does it end up? So started with 100%, it goes up to 200%, then you go down 50% on the new base. So it returns nothing, right? It comes back. So asset B in year one loses 50%, then doubles up 100% in the year two. So asset B it basically goes down to 50% and it goes back up to 100%. So that's when you look at them independently. But what if you had a 50-50 weight of the two assets? So someone is quick on math can tell me what does it change. So A goes up like that, B goes down like that. Now you have a 50-50, A and B. So let's look at the magic. So in year one, A, you have only 50%. So it goes up 100%. So that's up 50% on the total basis. B, you also weight 50%, but it goes down 50%. So you have lost 25%. So at the end of the year one, you actually, so this is the combined 50-50 portfolio, year one and year two. So you started with 100. You're up to 1.25 at this point. Okay. So at the end of year one, you rebalance, right? So you have to come back to 50-50. So what do? So this becomes 75, right? So you no longer have the 50-50 weight equal. So you have to sell A to come back to 50 and use the money to buy B. So you have a new 50-50% weight asset. Again, you can figure out the math. But what it happens in the following year, when you have this move, this comes back 50%, this goes up 100%. You return another 25% positively without the volatility. So you have a straight line. You can keep, so if this 2 year is so that's so-called diversification benefit. And in the 60-40 bond market, that's really the idea. People think about how to combine them. And so let me talk a little bit about risk parity and how you actually achieve them. I try to leave plenty of time for questions. So that's the return. And so let's forget about these. So let's leave cash here. Okay. So the previous example I gave you, when you have two assets, one is cash, all one. The other is not. The other has a volatility, sigma 2. You have this point, right? So, and I said, what's in between is a straight line. That's your asset allocation, different combination. Did it occur to you, why can't we go beyond this point? So this point is when we weight W2 equal to 1, W1 equal to 0. Right? That's when you weight everything into the asset 2. But what if you go beyond that? What does that mean? So, okay. So let's say, can we have W1 equal to -1, W2 equal to +2? So they still add up to 100%. But what's -1 mean? Borrow, right? So you went short cash 100%. You borrow money, you borrowed 100% of cash, then put into to buy equity or whatever, risky assets here. So you have +2, -1. What does the return look like when you do this? So RP equal to W1 R1 plus W2 R2. So minus R1 plus 2R2. That's your return. It's this point here. What's your variance look like, or standard deviation look like? As we did before, right? So sigma p simply equal to W2 sigma 2. So in this case, it's 2 sigma 2. So you're 2 times more risky, 2 times as risky as the asset 2. So this introduces the concept of leverage. Whenever you go short, you introduce leverage. You actually, on your balance sheet, you have 2 times of asset 2. You also short one of the other instrument, right? So that's your liability. So your net is still 1. So what this risk parity says is, okay, so we can target on the equal risk weighting, which will give you somewhere around, let's call it 25% bonds, 75%, 25% equity, 75% of fixed income. So, or in other words, 25% of stocks, 75% of bonds. So you have lower return, but if you leverage it up, you actually have higher return, higher expected return, given the same amount of standard deviation you achieve by leveraging up. Obviously, you leverage up, right? There's other implication of that. We haven't talked about the liquidity risk, but that's a different topic. So what's your Sharpe ratio look like for risk parity portfolio? So you essentially maximized the Sharpe ratio, or risk-adjusted return, by achieving the risk parity portfolio. So 60-40 is here. You actually maximize that, and this does leverage matter? When you leverage up, the